You think they go big? Is there a possibility they go 1 full percent?
No, I have to say the markets were quite worried about that after that last surprisingly high CPI report. The Fed, whether it was official or unofficial, again signaled not only in comments made by Fed officials after that meeting, but also there was another Wall Street Journal article which suggested that the 75 was the likely move, and so I don't think. I mean, now the market's only pricing in less than 15% chance of a 100 basis point move. I think going 75 basis points on top of a 75 basis points in June, and perhaps continuing to signal, despite some signs of slower growth, that they are going to continue to keep hiking. I think that will be enough for the Fed to do today.
We have seen some signs of inflation. I don't want to say coming down. Commodities have come down, gasoline prices have come down, but things like healthcare and education and rents, they continue to go up in most places. So balance it out as you will. But do you think that inflation has peaked? I mean, could the Fed eventually, the next couple of meetings, start that pivot so many talk about?
Well, let's see. So we do think that last CPI report for June marked the peak in terms of the year-over-year inflation rate touching just above 9%. And as you said, energy prices have come down. The headline figures in particular will look a little bit better. We do think the year-over-year rate numbers are going to come down. So it's going to look like the situation is improving on inflation, but it's still going to stay persistently high. And we have the inflation rate finishing this year at close to 5%. So that's still way too high. And at 3% at the end of next year, above the Fed's 2% target. So it'll be moving in the right direction, but not coming down to the target levels, certainly not quickly enough. And so this idea about a pivot, I mean, I say pivot because the market is pricing in expectations for a rate cut next year because there's expectation of fears of a recession. I don't think those inflation numbers give the Fed room to pivot. They might be able to slow the pace of hiking, but not outright pivot.
Yeah, and you can get some smart people that will argue that the inflation is actually higher than 40 years ago because they've changed the makeup of the consumer price index. Since we last recorded in 1980, we won't have to go down that road, Michelle. But what do you make of a 10-year yield at 2.8%? I mean, it's come down, from 3.2 or whatever in the last couple of weeks. I mean, the bond market seems to be telling a different story.
Well, the bond market is worried about a recession. We've had, a slew of weaker than expected data. The consumer's holding in very, showing resilience in terms of spending, but we've continued, whether it's home sales, whether it's the PMI manufacturing surveys, all of them are showing signs of slowing. And the market, of course, is jumping ahead to recession. And this idea that that's going to force the Fed's hand to pivot and at the very least will bring inflation down. And that's brought bond yields down. I just am concerned that I think the market may be missing the real fear or risk, I should say, that even if growth slows, inflation may be persistently high. And again, this idea that if the economy slows, it'll get the Fed to back off in terms of rate hikes. I just don't think that's going to happen. And so I think yield levels coming down are probably not sustainable. I think it's going to be very difficult for bond yields to move lower unless inflation really surprises us and comes in much lower, much faster.